At 2:32 in the afternoon on May 6, 2010, the American stock market began to do something that nobody had ever seen before. Prices started falling, not gradually, instantly. Within minutes, the Dow Jones Industrial Average had dropped nearly 1,000 points. Companies that had been worth billions were briefly trading for pennies. One stock, Accenture, a global consulting firm with tens of thousands of employees and decades of history, traded at 1 cent per share. Another briefly hit $100,000 per share in the same chaos. It was the largest intraday point drop in the history of the New York Stock Exchange, and it lasted 36 minutes. Then, just as suddenly as it had started, it reversed. Prices snapped back. By the end of the day, the market had almost fully recovered. Traders sat at their desks, staring at their screens, unsure of what they had just witnessed. Nobody, not the traders, not the regulators, not the exchanges, knew what had just happened. To understand the flash crash of 2010, you have to understand what the stock market had quietly become in the years before it. For most of its history, the stock market was a human institution. Traders stood in pits, shouted orders, waved their hands, and made deals face to face. Prices moved at the speed of human decision-making, which is to say, slowly enough that a person could watch the numbers change and respond. By 2010, that world was gone. Over the previous 2 decades, trading had been transformed by algorithms, computer programs that could analyze market conditions and execute trades in fractions of a second. High-frequency trading firms had built systems so fast that they measured their speed advantage in microseconds. They had moved their servers physically closer to exchange data centers to shave nanoseconds off their response times. The race was not between human minds, it was between machines. By 2010, high-frequency trading accounted for roughly 70% of all trading volume in American equity markets. The market that most people imagined, a place where investors weighed up companies and made considered decisions, had been largely replaced by a vast automated system that most of its participants did not fully understand. The morning of May 6, 2010 was already an unsettled one. Greece was in the middle of a debt crisis. European markets had been falling. American traders were nervous, watching the news from Athens. Into this jittery market, at 2:32 in the afternoon, a single trading firm in Kansas City executed an automated sell order. The firm was Waddell Reed, a mutual fund company. They wanted to sell a large position in futures contracts, a standard hedging strategy, nothing unusual. But they fed the order into an algorithm with a critical flaw. The algorithm was programmed to sell based on trading volume, not on price or time. It would keep selling as long as the market was active, regardless of what prices were doing. What happened next was a cascade that nobody had designed and nobody could stop. As Waddell and Reed's algorithm began selling, high-frequency trading algorithms noticed the unusual activity and began pulling back, withdrawing their buy orders from the market to avoid being caught on the wrong side of a large move. This was rational behavior for each individual algorithm, but the combined effect was catastrophic. As the high-frequency traders withdrew, liquidity disappeared. There were no buyers. Waddell and Reed's algorithm kept selling into an effectively empty market, and prices began to fall, not because anyone had decided they should fall, but because there was nobody left to buy. As prices fell, other algorithms triggered their own automatic sell orders, programmed to exit positions when prices dropped below certain thresholds, which pushed prices lower still, which triggered more automatic selling. Within minutes, the cascade had taken on a life of its own. Human traders watching their screens could not process what was happening fast enough to intervene. By the time anyone understood what was occurring, nearly $1 trillion in market value had temporarily vanished. What made the flash crash so disorienting was not just the speed of the fall. It was the absurdity of what happened inside it. Accenture, a company with revenues of over $20 billion a year, briefly traded at 1 cent per share. Not because anyone thought it was worth 1 cent, but because the automated systems that normally set prices had withdrawn, and the only remaining buy orders in the system were placeholders, orders placed by some exchanges at extreme prices just in case, which suddenly became the best available bids. Other stocks briefly traded at $100,000 per share for the same reason in reverse. Automated sell orders disappeared, leaving only extreme placeholder buy orders. These were not prices that any human being had chosen. They were the output of a system operating without human oversight, in conditions it had not been designed to handle. In the days and weeks after May 6th, regulators scrambled to understand what had happened. The investigation took 5 months. The final report, released in September 2010, identified Waddell and Reed's algorithm as the trigger, but noted that the real vulnerability was in the structure of the market itself. The market had become so dependent on high-frequency traders for liquidity that when those traders pulled back, even briefly, the system had no mechanism to cope. There were no circuit breakers fast enough to pause trading before the cascade accelerated. The speed at which the market now operated had outrun the speed at which humans, or regulators, could respond. Several years later, a trader in London named Navinder Sarao was charged with contributing to the flash crash through a practice called spoofing, placing large, fake orders to manipulate prices, and then canceling them before they executed. He had been doing this from his childhood bedroom, trading in his pajamas, allegedly moving markets worth trillions of dollars with a modified piece of off-the-shelf software. Whether Sarao genuinely caused the crash or merely contributed to the conditions that made it possible remains debated. What is not debated is that a single individual, operating from a suburban house outside London, could interact with automated systems in ways that amplified chaos across the entire American financial system. After the flash crash, regulators introduced circuit breakers, automatic pauses that halt trading in individual stocks if prices move too dramatically in too short a time. The rules were updated and refined over the following years. These measures helped. There have been smaller flash crashes since 2010, brief, localized disruptions that the circuit breakers contained before they could cascade. The system became somewhat more resilient, but the fundamental architecture of the market did not change. High-frequency trading still accounts for the majority of trading volume. Algorithms still execute orders in microseconds. The gap between the speed at which the market operates and the speed at which humans can understand and respond to it has not meaningfully narrowed. The flash crash of 2010 lasted 36 minutes. In those 36 minutes, the American stock market briefly ceased to function as a market in any meaningful sense. Prices no longer reflected the value of anything. They reflected the interaction of algorithms that had been designed to profit from normal conditions and had never been tested against each other in abnormal ones. The market recovered, the circuit breakers were added, and the conversation moved on. But the question that the flash crash raised has never been fully answered. We have built financial systems that operate faster than human thought, managed by algorithms that interact in ways no single person fully understands, in markets where the withdrawal of automated liquidity can erase $1 trillion in minutes. And the people responsible for overseeing those systems are still, in the end, human beings working at human speed. So the question is not whether something like the flash crash can happen again. The question is whether, when it does, 36 minutes will be enough time to notice.